some companies in the stock market are making big profits. And when you make a big profit, there are three things that you can do with this money. You can save this money for an emergency. You can take this money and reinvest it back into your company, or you can give this money away to your shareholders. So for example, McDonald's. McDonald's is a publicly traded company, which means anybody, you, me, or really anybody can go buy one share of the McDonald's company on the stock market. When you buy one share of the McDonald's stock, you become one of the owners of the McDonald's company. This is where things get interesting. McDonald's is making billions of dollars of profits, and they will save some of that money, and maybe they'll reinvest some of that money to open new stores and maybe make better hamburgers. But then the third thing that McDonald's does is they just give billions of dollars away to their shareholders in the form of something called a dividend. A dividend is a cash payment that a company gives you for doing nothing except owning a piece of that stock. Now, the amount of money you're going to make in your dividend is going to depend on how many shares you own. The more shares you own, the more dividends you're going to get, but it's cash that's deposited into your account generally every 3 months for doing nothing except owning the right stock. You don't have to go and flip burgers. You don't have to go and work in the corporate headquarters. You don't have to do anything. If you own the stock, you get money deposited into your account, and this can be a steady way for you to invest for this cash flow if you do it right. So let me break down the way that you can generate this type of cash flow in stocks into 3 different categories. You can invest into individual stocks, individual companies. You can invest into funds that are specializing in paying out high dividends, and you can invest into international companies that are focused on paying high dividends. I'm going to give you specific examples in each one of these. And I also want to remind you that for those of you that are investors or want to become investors, I just put together a brand new investing masterclass where I walk you through how you can start investing or find better investment opportunities before the crowd. I'll show you the exact system that my firm and I use to find investment opportunities before they hit the headlines. There's a ton of value in this masterclass. So if you want to watch this masterclass for free, all you have to do is register, and I have the link for you to join down in the description below. And as a bonus, you'll also get Market Briefs, my newsletter for investors, as a complimentary bonus just for joining and signing up for that masterclass. Let's start by talking about individual companies. This is what most people think about when they hear stock market investing. And here's an article on Yahoo Finance talking about the highest paying dividend stocks in the Dow Jones. 3 of the stocks that this article talked about are Verizon, Chevron, and Merck & Company. So let's break this down. But of course, I gotta remind you, investing is risky. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Okay, I'm not telling you what to invest in, nor can I tell you what to invest in, because I'm just a random guy on YouTube. I'm not a financial advisor. Let's start with Verizon. At the time of me recording this video, Verizon is paying out a dividend of around 6.2% a year. Chevron is paying out a dividend of around 4.3% a year, and Merck & Company is paying out a dividend of around 3.8% a year. What that means is if you were to invest $100 into Verizon, you're going to get paid $6.20 of cash flow for doing nothing except owning the stock over the course of a year. Now you might say, well, Jaspreet, that doesn't sound like a whole lot. Well, the idea with dividend investing is to keep investing your money consistently. That way you can work to acquire more shares of this thing that keeps paying you dividends. And then as you get that dividend, you can keep reinvesting that dividend. That way you can accumulate a larger and larger share. That way, as you own more shares, each share is going to be depositing money into your bank account. And if you do this year after year after year, well, slowly you'll start to build up a solid stream of income, which you can use to buy more shares of that company that's paying you dividends. Or you can also use it to start funding your lifestyle, paying for your car, paying for your vacations, or whatever you want to do. But it takes time. However, there's something that I want you to understand about investing into individual companies, because the mistake that a lot of people make is they say, okay, Jaspreet, if I want to invest for dividends, I should take a look at this number right here. Verizon is paying out the highest dividend, so that's got to be the best investment. But that's one of the biggest mistakes you can make, is making your investment decisions based off of this dividend number, because you want to own a good asset. You want to own a good asset here, because if that asset is good, that means number one, it should be going up in value, but also number two, if it's growing its profits, that means the amount of money it's going to be paying you in dividends is also going up. So even if you don't increase the number of shares that you own, you're still increasing your income because you have a good asset that's paying you month after month after month. So we can take a look at Verizon. It's paying out a very strong 6.2% dividend, but if you look at the Verizon stock over the last 5 years, the Verizon stock is down 25% over the last 5 years. And this is where investing in individual companies comes with the highest risk for the highest potential return. Because now if you invest in a good company that goes really good, well, now not only will the value of your investment go up, your dividends will go up, but you also have the opposite potential as well. The company investing could also go bankrupt. Now, not only do you lose your income, but you also lost all the money that you put in. So if you're going to be investing here, understand you have the highest potential return, but you're also taking on the most risk, which is okay for some people, but for a lot of people, it's not worth it because you don't want to keep up with the earnings calls. You don't want to keep up with the financial statements. No big deal. This is where we can take a look at number 2, ETFs. An ETF is an exchange traded fund. This is a basket of stocks. So now you're not going to invest into one company, you're going to invest into a group of companies. This way you have more protection, less risk, and less potential upside, but still consistent income. So again, 3 very different examples here. Number 1 is NOBL, Noble, which at the time of recording this video is paying out around a 2% annual dividend. And Noble is investing in companies that are a part of the S&P 500, meaning this is only investing in companies that are in the 500 largest companies in the stock market. But not just that, they also have to be paying out a dividend. And not just that, they also have to be a dividend aristocrat, meaning not only have they paid out a dividend, but they must have had to increase their dividend every year for at least the last 25 years. So this is focused on investing in those specific large companies that have been working to increase its dividends consistently. That way, hopefully, you can continue to see dividend growth. That's Noble. Another example is VYM. As a disclaimer, I'm personally invested in VYM. This is a fund created by Vanguard, and this is focused on investing in a broad basket of high dividend paying stocks in the United States. So not as specific as this, but it's investing in a broad basket of high dividend paying stocks in the United States. And if one of those companies were to go bankrupt, well, this company would kick them out and replace it with another company. At the time of recording this video, it was paying out a 2.6% annual dividend. And then we have MORT, M-O-R-T. This is a REIT, Real Estate Investment Trust. At the time of recording this video, it is paying out a 12% dividend, which can sound very attractive. But remember what I talked about here. High dividend yield doesn't necessarily mean good investment. This is focused on investing in real estate investment trusts, more specifically companies that are involved in the dealing of mortgages, which is very risky. So you'll have much more volatility here, more risk for more potential return. And you have to know where in your life cycle of your investment journey that you are. Do you need more risk or do you want more stability? Because depending on what you need, you should change how you invest your money. But this brings us to category number 3, international investments. Everything that we talked about so far, the stocks and the ETFs, are focused on the United States market, but there are certain countries around the world that are smaller, that are working to grow, while the companies inside of those countries are also working to grow. So you can potentially see a double benefit where the company is growing and the country is growing. So you could see a growth in dividends. But there's also a risk because these countries might not be as stable as the United States. Their currency might not be as stable as the United States dollar. Their military, their government might not be as stable as the United States is. So you have more risk for more potential return, but you can also get some higher dividends. Take a look. VYMI, this is another ETF created by Vanguard. It's essentially the same thing as this, but this is focused on international stocks, not in the United States, that are focused on companies that have higher than average dividend yields. And a lot of these companies are in emerging markets, meaning the smaller countries that are working to grow. So you could see the potential for the country to grow and the company to grow, but more risk because it's not the United States. So you could also see those same countries and companies fall, which could hurt the dividends. But at the time of recording this video, is paying out a little bit over 4% a year in dividends. Another one is LVHI. This fund is focused on investing in more of the developed countries around the world, not the emerging markets, just the developed countries. So it's working to provide a little bit more of stable income outside of the United States. But again, risky because it's not the United States, but a little bit less risky than just emerging markets because it's focused on the developed markets, trying to produce that stable income outside of the United States. And at the time of recording this video, is paying out around 3.6% a year. So if you wanted to get cash flow, you can invest in real estate. It takes the most work, the most time, the most money. Or you can invest in stocks, which you can do through specific companies. You can do it through ETFs. You can do it through international investments. Again, this is just a small taste of some of the opportunities out there. There are tons of opportunities out there, and so you can just do a little bit of digging to see what you like. The key to winning here, by the way, I didn't mention yet, is to consistently keep investing your money. I call it ABB, always be buying. To set up a system where every week, every 2 weeks, or every month, you're just gonna keep buying this cash flow. You're gonna keep buying shares of this thing that you want to own. That way you can accumulate more shares consistently year after year after year. After you generate that dividend is also gonna buy you more shares. That way, 5, 10, 15 years from now, you can have a lot of shares of this dividend producing thing, and that can start to produce a solid stream of income that you can use to buy more dividend producing shares that's going to pay you more money, or you can use it to pay for your car, your vacation, or whatever you want to do. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.